The 360 on Energy and Carbon, hosted by 360 Energy. Lasse leads the Global Resources Research team at Accenture, driving thought leadership as a part of Accenture Research across energy and materials sector. Originally from Finland, since 20 years he's based in Düsseldorf, close to the German industrial heartland of the Rhine-Ruhr area. Using both traditional and new AI-first research methods, he and his global research team are shaping insights on the reinvention of heavy industries and the energy sectors, commonly characterized by asset-heavy operations, commodity markets, and industrial decarbonization. Now let's get into the episode with Lasse. Welcome back, Dave.
Lysandra, great to be back. Our colleague is from the UK, he's on vacation, so we're going to be taking this on ourselves. I'm looking forward to our guest today.
Yeah, I'm sure we'd rather be where John is, but this is the second close best option, so we're excited for today's episode. Today we're joined by Lasse Kari, Global Energy and Resource Research Lead at Accenture Research. Welcome.
Thank you. Nice to be here.
Let's say it's a real treat. Just for audience benefit, I was at the eWorld in Germany, one of the biggest energy conferences, and I was fortunate to sit in to listen to Lasse about the topic that we're going to have today. So I'm going to start this off and get this going. So, with the title in your presentation at eWorld deemed Relocating Industry Potential for European Competitiveness, it really invites a certain interpretation. Could you unpack the use of the repack, and what message does this framing convey about shifting industrial strategies in Europe today?
Great. Yeah, thank you, David. And thanks again for having this discussion. I think it's a very fascinating topic. And to your question, I think sometimes we might tend to oversimplify things. Just talk whether the companies would be staying in Europe, business as usual, or whether they'd be forced to leave Europe, the industrialization period. So this new wording, I think, is trying to reflect the two parallel stories, if you like, that we're observing at the moment in Europe. On one hand, we are witnessing those risks of relocation of certain industrial activities. So moving the home for part of your large family, if you like, to a new country, with some of the companies that are evaluating where they're going, whether their full scale in Europe is still needed and competitive, and whether there are, on the other hand, persistent challenges that are structural. So that's one thing. But the other hand, you have also the thought about locating and building the first home for that new young family that wasn't there before, or even adjusting that existing location and creating the new growth in the region. So I'm seeing it as a bit of gardening, where you are cleaning up older trees and making room for those same trees to either grow more or to plant new plants. So instead of industry existing Europe, I think it's more about the reshuffling of, you might have some of the legacy capacity that is needing to move out. You might have some of the companies or parts of the companies that are staying just in a sort of a different form that you might have known them today. Or you might have in parallel that new higher value segments that are being built out. And sometimes an entire different region could have a completely new type of segment emerging in Europe versus where it used to be. So the overall discussion, I think, is about the resilience that the European industries need to just keep in mind to stay competitive in the global market.
It's an interesting topic because this is not only going on in Europe, but in other countries as well. And I know there's a lot of people think about this, but they haven't really addressed it. So I'm looking forward to dig into this. When your data suggests concerns with EU and UK industries now extend well beyond just the energy crisis. From your perspective, what are the most pressing structural challenges currently facing European heavy industry?
Right. So the high energy costs, they were a major topic a couple of years back. So we had record prices for natural gas, electricity across Europe, had huge impact on margins, especially in those heavy industries. Recently, we've been observing a bit of a change in the tone, at least in the way the companies themselves are talking about the challenge. So you have things like the global oil prices, which just a couple of weeks back went down to a 4-year low. We have the natural gas prices crashing since 2022. You have a better infrastructure to connect to the global supply, or that electricity prices often going down along the gas prices. So in any case, there is a bit of a change in tone, but we are still meeting and facing that issue in a global comparison. We have still high energy prices. The companies are quoting the costs as a top investment barrier in Europe. But what we are observing today is increasing sentiment on the economic uncertainty, stagnating growth, demand and investment affected. And in terms of the economics, is what that means for the competitiveness, you have different forms of levers of costs and demand. But it's also beyond the economics, I think. What we've been seeing recently in research we've been running is that what the companies are saying about the challenges, let's just pick the topic of industrial decarbonization, which is, I think, reflecting very well what the general sentiment in the industry is across the topics, is that there are other concerns. There are other factors beyond the economics. You have the scarcity of the talent. You have stakeholders, consent, approvals, including communities and consumers that are worried and holding back some of those projects to materialize. You have inflexibility of the infrastructure. You have inflexibility of the supply chains. And also you have that availability of stable and green electricity supply, which is, by the way, not just an issue in Europe, but also in other parts of the world. So multiple challenges, I think, that sometimes are forgotten in the discussion.
Yeah. Clearly, the energy markets are volatile, certainly in Europe because of the issue with the Ukraine. And now my sense in being there, being a North American and seeing the speed of which you're doing the transition and the commitment that you're making, it's quite impressive. Like, you're not wavering. And I know there's a need because you can't waver because there's a shortage of energy, but there's still this commitment towards the energy transition. And I'm thinking and hoping that speed of this transition will reduce the energy pricing as you're starting to experience with conventional, but with the new renewable side. So I'll be interested to see how fast that goes, because I believe Europe is leading the charge in this. And there's a lot that people around the world can learn because of what you're doing, the speed of what you're doing. But I get it's more than just energy. There's other things that have to be reflected on. Thank you for sharing.
You mentioned that direct voices on closing down in Europe are rare. What factors make companies hesitant to speak openly about relocation risks, and what indirect indicators should policymakers and analysts be monitoring instead?
Right. So I guess, first of all, just to make sure that we are still regularly hearing voices from the industry that are talking about downsizing and closures in Europe. Back in February, we had a look at the preceding months compared to preceding years of individual company signals on closures. And we saw that there was a tendency of those kind of disruptive, dramatic disclosures about the closures becoming more rare, especially in the heavy industry that I had focused on. I think those dramatic decisions have been taken in many cases already a couple of years back, and now we're just seeing the tail of those decisions. It's also, I don't think, necessarily about the hesitance to speak openly. It's about the relocation being a major decision generally. It affects the investor sentiment, the consumer reactions, customers, the workforce, for example. So you don't take those kind of decisions and make those too early and publicize those too early before it's final. Another thing is also that moving to another region, you need to have certain pre-requirements filled. You have to have an available infrastructure. We've seen outside Europe, many regions, frequent grid instability, power rationing, which is disrupting production, disrupting supply chains. And it's also not about the regular disruptions. One of the interviews we've been running recently was that a steel executive was mentioning that they'd be hesitant to build a new generation of green steel mill in other regions if there's any kind of uncertainty of how many years will it need to have an approval for a grid connection. Or it can be about also the skills. Will I suddenly find those specialized workforce and skills in the new location? The companies are talking about the talent scarcity, especially in the industrial decarbonization in every region. So there are risks. also on the moving part, and the uncertainty about the directions of those alternative markets and locations is there. And maybe the other question you had about the other indicators to monitor. So you, again, looking at what we've seen in the recent research is that the number of announcements of delayed or canceled investments, be it in green infrastructure or conventional capital projects, that has been going up. And that kind of announcement is not about the closures in Europe. It's about canceled or delayed additional investments. Or if you look at the number of years for new projects to materialize, or that can also indicate that there is a slow consent or slow process of community approvals for the new projects. It can be about shifting trade routes and partners. It can be about M&A, the same assets, the same location, unchanged, but it's just changing hands to new owners. And in general, I think this kind of announcements of the companies and public space, which is very closely scrutinized before it's being made public, optimizing, adjusting the locations. It's a sentiment that it's worth keeping an eye on.
It's really complicated. Let's say we just had an announcement yesterday. Honda Canada was building multiple plants, I think up to 4, and one of the plants was supposed to be running by 2028, $15 billion. And they announced yesterday that they are postponing for 2 years. And we know them personally, it's a client of ours, but there's several issues. You've got the issue of they're building EVs. Is the market there? So are they slowing down because the market isn't there? Do they build this plant and just sit idle? So you've got that issue. Certainly, you talk about infrastructure. That's an issue everywhere around the world. If you're building these new plants, if the electrical infrastructure is not there, could they build it quickly by the time? So there's so many different dynamics that you have to be, the consumer has to really be attentive to understand what is the driving force and not put it on just one thing. I think it's quite challenging. I want to come back to the question because in your presentation at the eWorld, you showed quite a divergent approach in Germany, UK, Italy, and Sweden. And what explains the difference from this industry perspective? And are there operation patterns or strategic approaches that seem to resonate across borders?
Right. Yeah, great question. Europe is characterized by the fact we are a mixture of very different kind of countries, different kind of history and legacy. You might have a very different kind of electricity or energy mix in a country or the historical basis of natural resources. For example, we have today practically all electricity in Sweden produced from green sources, which is a very strong basis for electrification of industries. Or if we take UK, you have just last year announced the closure of the last coal power plant. You're building out nuclear power. You have a country that has become a leader in the offshore wind globally. It's building industrial clusters jointly between heavy industries and energy companies. So there are many, many differences because of the energy mix that is being there and that is changing. Then you have the industrial structure, which is also a legacy topic. You have had in Germany the long legacy of hard to abate industries like chemicals or steel and cement, while Italy has been more focused on lighter manufacturing, or Sweden has been strong in mining and forest industry. So very different starting points there. And then you have also different global trade partners. So each country has different mixes or weights in terms of who and to which countries they export to or import from other different kinds of regions. So that legacy and that kind of a historical background that each of those countries have developed sometimes over the past centuries is where the differences are also.
I never thought of it that way. It's quite a geographic difference on how industries are being segmented into different countries that impact what they do and how they do it. I never thought of it that way in Europe, but thank you for that.
You identify 3 strategic orientations among firms: move out, reorient, and stay. Could you explain these categories further and what drives a company towards one path over another?
Separating them first, we have the moving out, which is often the case is you have a sustained structural risk to competitiveness, to a particular type of operations in a region. And even in those cases, it's typically not about entire companies, but only certain facilities or certain business lines It can be also not about closures, but downsizing the plants instead of closing them down completely. Then you have the staying, which is the other extreme of companies that are unable, in some cases, to move their operations just like that. You know, I have often heavy assets that have been built and installed a couple of years back, have 20-year lifetime. In general, the remaining lifespans are quite long. Or you might have other companies that have very deep roots in the local relationships with customers or suppliers or cross-industry partners. You might have other companies where it's a natural choice for an industry to be there where the demand is, like in the case of cement, which is not really economic to transport around the regions. In any case, whether a company is moving out or staying and keeping the facilities without downsizing the same location, there's a high chance that you need to still look at the resilience of your operations, of what you need to optimize. Do you need to improve the efficiency? Can you use the latest technology, including artificial intelligence, what is available for you at the moment to make sure that you stay competitive even if you're not moving out? And then you have something in the middle, I guess, that I would call the reorientation, which is about, for one, the new growth into new areas, like decarbonization. We had the EU exports of green technologies increasing by 60% in the past 7 years, compared to around 20% in the US. Data centers is also one big topic. We have not only hyperscalers, but also utilities or oil and gas companies. Because of the infrastructure that you need around the data centers, that is another very much emerging topic. You might have a repurposing of the old infrastructure where it's possible. You can see already companies that are looking into converting an oil refinery to a producer of green fuels, green chemicals, in which case the location and the owner might actually stay the same, but the business would look very different in the future. Or you might have to rebuild locations in the same country, but somewhere else where you have a cluster of other industries, but that is closer to clean energy supply, that is easier for those companies, including yours, to collaborate in one physical location, to have synergy between each other and to have a close proximity to the clean energy. So a lot of different options also to that third option of reorienting your operations.
When you talk about relocating heavy industry like sectors of chemical, steel, cement, and utilities, where do you see the greatest vulnerabilities with those groups?
Mm-hmm. Yeah, I think there's at least one thing related to the certain level of input dependence in Europe in terms of importing oil, importing natural gas, importing raw materials, minerals, equipment from other regions. That's one thing. The other is, in many European locations, you might have an exceptionally strong presence of heavy industries, which means, again, that you have those long-term local commitments to those assets for the companies based there, more amplified as a challenge to be more flexible for changing that. And then even if we are a fairly stable region in terms of the electricity availability of electricity and energy, we do face also the problem of the increasing share of renewables in the power generation. We had just a couple of weeks back a major blackout in the Iberian Peninsula of Portugal and Spain, which is likely originating from lots of smaller scale producers going off the grid at the same time. So those are kind of the nascent problems that are coming to the system as we go and transition towards the new economy.
So just follow up that. Conversely, what are the most promising openings for renewed European competitiveness?
So maybe on that topic of the energy system stability, we had a few hiccups recently. I think still that kind of interconnectivity of the region, for whether it's for goods or services or labor or also energy, is a differentiator. I believe we have the world's largest interconnected grid in Europe. We have 40 different kinds of transmission operators from different countries that can balance the gaps or volatility that you might have in one part of the system with the others. Or if you have, and take that topic of the data centers, we actually recently looked at in our research the US market. One of the key barriers that coming out for building out the data centers was that the US grid has a risk of bottlenecks between the regions even within the individual regions. If you want to build a data center and then start looking at how much you actually have power generation in that region, you might face a bottleneck. So I believe that the interconnectivity is one. The other is alliances. We are worldwide. We have more than 70 partners that we're trading with as a number one trading partner. And then there is that big opportunity about the decarbonization of, I was just a couple of weeks back approached by the friends of my son. I was going to the primary school for bringing him to school by car because cars mean CO2. And I wasn't quite expecting that. There is that public sentiment and support since for quite a while in Europe for decarbonization, low carbon economy. That's visible in the business space too. We have about 2/3 of the European companies that have been cutting their operational emissions. They've set net zero targets much at the higher level than many of the other peers in other regions. We have the cost of solar and wind power falling below that of fossil fuels. And again, with the data centers, there's then the connection of not only the decarbonized economy, but also the digital economy, infrastructure, fiber connectivity, combined with low temperatures like in Finland or Iceland, which sort of together with clean energy is a strong basis. And I think we have multiple other topics, but we can touch on those a bit later on.
Dave and I, based in Ontario, Canada, are lucky to have relatively clean, affordable, and reliable energy. However, in other regions, high energy costs are a recurring theme. What are the most innovative strategies you've observed among companies aiming to manage this challenge while remaining anchored in Europe?
Right. Yeah, so first of all, starting with maybe the electricity costs, many companies have been trying to insulate themselves by sourcing the energy in long-term agreements, corporate power purchase agreements. They were hitting what I saw just last year, the all-time high. And it's also important to remember that the electricity prices in Europe are not always fixed, depends by the daytime, depends on the season. So there's an opportunity. Many companies are using what we call the demand flexibility. There is a rapidly growing market for demand response, where a lot of the heavy industrial companies are actually monetizing by offering their flexibility in their consumption to balance the system. We've seen also initiatives between the different countries to have a cross-border demand response, which would be unique in the world. And all that obviously can be then augmented and amplified by using artificial intelligence, where you would optimize the production to switch on and on where it's possible, depending on when the cost of electricity is the lowest. So I think that those are some of the themes, again, where the digital plays a role to balance the system. I'm sure there are multiple other ways also the companies can manage, not just the electricity cost, but also that of natural gas and other forms of energy.
When you were going through your research, you were mounting competitive pressure from Asia and from the United States. How do those challenges differ in nature? And how are firms responding to them from an operation or strategic standpoint, Lasse?
Mm-hmm. Right. I think Europe has a lot to learn still also from other regions. You have North America, for example, with very low energy costs. The industrial electricity prices in Europe are sometimes nearly triple of those in the US. Or if you take Asia, where you have a lower cost of not just the labor, but manufacturing and materials, sometimes really multiples of difference compared to the European ones. You have Asia also with rapidly growing markets. That demand growth for many industrial products is in Asia obviously much higher than in Europe. But what the European companies are doing is often to respond through the innovation, be it circular economy for chemicals or metals, or be it using carbon capture and storage for cement production, to often with the goal of positioning yourself as a new type of producer or a low carbon building materials producer or a premium low carbon biofuels producer. The data centers being, again, another area of positioning yourselves. Well, then there is, I think, the whole topic of innovation and skills, where I just saw recently that there was a quote of 1/5 of world's clean and sustainable technologies are developed in the European Union. Worldwide, Europe is the leader in developing wind turbines or low carbon fuels or electrolyzers they need for green hydrogen. And it's also about the skills. I just saw a European investment bank report recently where the companies in the US were quoting the available skills as the biggest barrier for investment in the US. And those worries were even at a higher level than in Europe. There's a lot, I think, in this space that the companies can still be competitive and think about where the advantage might be.
Looking ahead to 2030, how do you envision the landscape of European heavy industry? And do you anticipate more companies relocating, or is there potential for a genuine industrial renaissance in Europe?
Right. So it's still a few years until 2030. In the meantime, I think in the shorter term, you still need that resilience. You need, despite the different challenges in the market, you need to stay focused on where you can pull a lever, where can you optimize, what can you do without dramatic decision of moving out. There is light at the end of the tunnel. Despite all of the challenges, last year, the European industrial sector investments were growing by more than a fifth compared to the previous years. This month, I just saw in Germany, the investor morale rebound significantly from April. So there is already now signs of the resilience paying off, to stay put, to think about how can I make myself more competitive. But in the long term, I really believe there's a real opportunity. I saw some of the anecdotes, I think, from the World Bank and the World Economic Forum and IMF. All have been saying that the sustainable investment and green infrastructure investment, it can create economic growth, it can create jobs. You had $1 trillion of investments globally in green energy in 2023 versus the 2022, even if there was the crisis. And that kind of investment, it can really boost the economy. And we have that green opportunity. In the UK, we just saw the net zero economy growing 10% last year. And we had the renewable capacity increase by 30% last year. Or if we take the chemicals, which was recently also estimated that the demand globally for green chemicals and sustainable chemical products, they can increase by 70% within just 3 years. So it's into a $500 billion market. So that's an opportunity for the European producers.
So I have a follow-up, and you may choose to answer it or not. Let me just bring this up because of what Lysandra just conveyed, how heavy industry is responding. So my read of the situation is European is really going to start advancing their military equipment manufacturing, things of that nature. If that's true and it resonates in Europe, will that help the heavy industry stay in Europe, do you think? And if you don't want to comment on that, that's fine too. Finally, again, there was many things in your presentation I found fascinating, but you briefly referenced that a lot of the research you did was AI supported during your talk. And could you expand on how these tools informed your analysis in the presentation you made?
Yeah, so I think that AI methodology is something that we're increasingly using at research. We've been, in the past, let's say 10 years ago, still done research by actually looking into manually in individual company documents of what are they saying about certain topics. While now we're not generating the insights or just having the AI create pictures for us, but we are using what we call the human and machine collaboration of you have multiple stages of AI can help you to gather an initial set of statements by companies, let's say anything related to the talent in the industrial decarbonization. And we'll have a look at then afterwards with a human being, even if it's a few hundreds of statements, it's still manageable because they've been collected, whether they're relevant or not. Then the next stage, we can use the AI to tag whether a sentiment is positive or negative. We can use the preliminary kind of help of AI to say if that's more of an action-oriented statement or is it an observation. We can also get the help of AI to define whether this is a more of a current market-related statement or rather about the next few years. But in every step of the way, you need to have somebody who looks at the results and does the final judgment of, okay, that's yes, correct, no, or maybe something in the gray zone. And that we believe is a realistic way of doing research and getting a lot of the insights we were earlier referring to by measuring the company's statement sentiment, measuring what the companies are prioritizing, what they're seeing the challenges. And if we ever need to go back, we can actually say that that's the statement from that company. We're not making it up. We're not using AI to summarize it. We only use this as a tool to measure something that otherwise would have taken us months to do. So that's a way for us to do a quick pulse sentiment, I think, on the market in a mixed way of the human and machine.
Well, the work that you presented and you're discussing, really important, I think, to industry in general around the world. So I'm quite interested as this technology evolves, because it's still quite early and it's only going to get better. But the research that can be generated by using this by organizations like yourself will be really helpful for companies to have that knowledge so they can make better decisions. So I applaud your organization for taking that on and sharing that with us.
Great.
Lasse, to end off this
maybe to also mention that some of these insights we are just about to publish on a study about the green infrastructure investment, which is very topical for the European audience, I think. And we're looking into what are the companies thinking of what matters to accelerate those projects. How can you overcome the investment hurdles? What kind of levers can they pull? What's the perceived value of the AI? Because both of those green and AI technologies currently are the sweet spot for the European companies or the data and the clean digital backbone that you need. So we're trying to solve a challenge which seems unsolvable in that new report. And again, basing on the facts of just hearing it out from the industry itself.
Thanks for that. Lasse, to end off this episode, what is the biggest takeaway for our listeners?
I think it's really a short format of the resilience can be a new form of competitiveness. It applies today very much to Europe. It doesn't need to be a black and white parts of the industry leaving or staying in Europe, but it's about those that can stay, can have a real opportunity in terms of market shares, in terms of the growth. And whether it's through the AI or the digital innovation or the green infrastructure or the green manufacturing in Europe or new types of industrial alliances, those companies then can drive, will be the ones, will be more independent from the external world, the external factors, and they will also be more able to adapt to those new market conditions.
Thanks for that. Dave, what's your biggest takeaway?
I think what I've captured in this discussion, but also in the research that Lasse was showing, is that yes, Europe has been significantly impacted by high energy pricing. And that has been a daunting challenge. But that daunting challenge is actually, they're turning it around and making it, instead of a crisis, which it was, it's now an opportunity. And they're, what I perceive as North America, are doing things differently, faster than any other country because they have to. I think of North America, say we have an abundance of energy, probably fossil fuel based. We don't have that urgency because we've got this abundance. But I believe because of what Europe's doing and the way the world has to go, because we do have to go this route, that Europe will be fine. In fact, we'll continue to look at you for your leadership on what we can learn on what you're doing and how we can do it better. Yes, everyone complains about high energy costs, but if you actually look at it and look at it through a different lens, you can actually make your organization better by finding different ways of using energy or being more productive or things of that nature. So that's what I've captured from this talk, but also in your presentation in Europe. And so thank you for being on our podcast today. Lysandra, how about yourself? What did you capture?
Yeah, I think similar to you, crisis breeds opportunity, right? And I think similar to other podcast guests we've had, it's very clear that nothing is simple in this space and it's very dynamic and it's constantly changing. And Lasse referred to that a few times, but there are every year to year, we can find new investments, new opportunities. It's really an industry to watch, and it's not anything that you can really predict because, again, we've seen in the last couple months how things have changed in North America, outside of North America. It'll be an interesting time to watch the energy industry and investments that companies are making these next couple of years.
Never boring. Absolutely.
That's for sure. We're always entertained.
Yes.
Absolutely. Great.
All right. Well, thanks, Dave and Lasse, for your time today.
Thanks very much, Lasse.
Thank you for
Lysandra, it's
having
been a
me.
pleasure. Thanks again.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn posts. See you next week.